Welcome to the Deep Dive. We're here to help you get quickly up to speed on important topics. Today, we're digging into a company, well, most of us use pretty regularly, MasterCard. Ticker is MA. We've sifted through a pile of research, financials, the works, really, to figure out what makes this payments giant tick. We'll look at some surprising strategies and what it might mean for how you see the financial landscape.
Okay, let's get into it. So MasterCard, fundamentally, it's this global tech company, right? Connecting banks, merchants, us. Across, over 210 countries? Their bread and butter is still fees on transaction volume.
Yeah.
And this is the interesting part, they've made this big strategic shift. It's not just the network anymore. They're heavily into what they call value-added services.
Okay, value-added services. Okay, like what exactly?
Think cybersecurity, data analytics, fraud prevention tools.
Yeah.
And it's not small change. This part of the business pulled in $9.3 billion in 2023. That's an 18% jump year over year. Huge boost to revenue. And, some analysts are saying MasterCard is actually beating Visa, their bigger rival, in selling these kinds of cyber and data services.
Wow. Okay, so they're building this whole ecosystem around the core payments. It's not just about the swipe fee then.
Exactly. It diversifies their income. And honestly, it probably makes them stickier with their clients.
Yeah.
Deeper relationships.
Makes sense. But it sounds like a different ballgame than just processing payments. Are they facing new challenges or competitors in that services space?
Oh, absolutely. The whole payments world is, it's transforming. You've got real-time payments popping up everywhere, instant transfers, digital wallets, obviously, Apple Pay, Google Pay, and this idea of embedded finance where payments just disappear into other apps.
Right. You barely notice it sometimes.
Exactly. And MasterCard's not setting back. They're pushing things like MasterCard Move commercial payments. That's about enabling real-time account-to-account payments across borders. They're investing a lot in these new payment rails, the tech infrastructure, basically trying to stay ahead as things move beyond just plastic cards.
It's fascinating. We just tap and go, right. Never really think about all the tech and strategy worrying behind it. So how has all this innovation, this foresight, actually impacted their financials and, the stock?
Well, financially, the picture of the last decade is remarkably consistent. Really solid growth. Revenue, operating income, net income, earnings per share, all heading nicely upwards. And they have this asset-light model. They don't own tons of factories or physical stuff.
Right, less overhead.
Exactly, which leads to these really high gross profit margins, give them huge operational leverage. A small revenue bump can mean a much bigger profit jump. Plus, they're quite aggressive with their capital. They buy companies, especially in AI and cybersecurity. And they return a lot to shareholders, share buybacks, dividends going up.
Okay, sounds pretty rosy. But you mentioned surprising challenges earlier. Anything specific in the financials?
Yes, one thing that stands out is their debt. Long-term debt has climbed quite a bit. We're talking from around $3.2 billion back in 2015 to over $17.4 billion now in 2024.
Whoa, that's a big jump.
It is. Now, it's common for companies investing in growth, but it's definitely something to keep an eye on. Higher debt means higher risk, especially if interest rates change. Could limit flexibility down the road.
Okay, so strong growth, smart investments, but rising debt. How has the market digested all this? What about the stock price itself?
The stock performance. Yeah. It's been, exceptional long-term. Get this. If you put $1,000 into the IPO back in 2006, today, July 30th, 2025, it'd be worth roughly $132,583.
Seriously, that's incredible.
Yeah, it works out to like a 29.38% compound annual growth rate. Pretty stunning. And over the last 10 years, only one minor down year for the stock. So clearly, the market has had a lot of confidence.
Okay, undeniable strength in the business, consistent growth, happy shareholders. Sounds almost too good to be true. But you mentioned our sources looked at this through a specific valuation lens. What did that perspective show? Any flies in the ointment?
Right, this is where it gets interesting, especially for value-focused investors. If you measure MasterCard against the classic principles of Benjamin Graham, the father of value investing, the stock looks, pretty expensive, overvalued, arguably.
How so? What metrics are we talking about?
Key things like the price-to-earnings ratio, the PE, it's around 39, and the price-to-book ratio is about 11.5.
Yeah.
Graham's traditional approach favored much, much lower numbers, like a PE below 15. He really emphasized a margin of safety.
Buying significantly below what you think the company's truly worth.
Exactly. So while MasterCard is clearly a high-quality growing company from that strict value perspective, a lot of its expected future growth seems like it's already baked into the current stock price. The margin of safety just isn't there according to Graham's rules.
Okay, so that puts things in perspective. For you, the learner, looking at MasterCard now, you've got this really strong, resilient business on one side, great growth in those profitable services, global reach, shareholder returns. But then you have to weigh that against, well, what looks like a high valuation by traditional standards, that growing debt pile, plus the constant competition and regulatory stuff that always hangs over payment companies.
Mhm. It's definitely a balancing act. Quality versus price.
Absolutely. So, MasterCard, clearly a powerhouse, shaping how we all spend money. But as we've seen in this deep dive, even the best companies present a complex picture for investment. So here's something to think about. In this world of fast tech changes and financial innovation, how do you personally weigh undeniable quality and growth against a price tag that might make a classic value investor pause? Something to chew on as you navigate the world of finance.